Let's delve into this now with the Vice President, Economic Research at Financial Derivatives Company, Dr. Ifeoma Nwokolo. Dr. Nwokolo, good morning and welcome to the program.
Good morning, Amy. Thank you for having me.
Good to have you. I wonder if you caught up with the conversation that I had earlier with Chinan from the African Energy Council about how crude theft is reducing. And I see the impact now in the GDP, even though from last quarter we saw real estate also doing very well, services also taking over. What's your overview of the compartment or the composition of our GDP as a country at this time?
Yeah, we saw that the recent GDP Q2 2025 was a strong growth of 4.23%, way higher than what we had in the corresponding quarter. So in my analysis, I'm going to be comparing apples with apples. So we're in Q2, so we're comparing with corresponding quarter Q2 2024. And this strong growth that we saw is a 4-year high since Q2 2021.
Sorry, Dr. Nwokolo, let me just interrupt you. If you want to compare Q2 2025 to Q2 2024, aren't we talking about the rebased number? Are you using the rebased of 2024? Because, you know, that also makes a lot of difference. The rebasing.
Of course, it makes a lot of difference, but when you talk about Q2, at least activities setting in Q2. If you're comparing Q2 and Q1, of course, we know that Q1 we have less activity because of the festive period in December. So the economy is just gradually kicking in. So there are not much activities in Q1. So what we saw in Q2 2025 is basically more of reflection of the rebasing, because the rebasing was good. It was supposed to be, because we know that a lot of activities were underestimated, and these activities were included in the recent GDP rebasing. We talk about the creative industry, we talk about the renewable energy and the likes. These are fast-growing sectors that were included in the sector, and I think that's why we saw these strong GDP growth of 4.2 compared to the previous quarter, which is 3.48. This is quite high, even compared to the previous one. It was 3.13%. So looking at the GDP holistically, we saw that when compared to corresponding quarter, we saw that about 32 activities expanded, 10 slowed, and 4 contracted. And those activities that slowed included the health, human health and social services, included food and beverages, included forestry, included real estate, and the likes. Then the ones that contracted were the textile, motor vehicle, metal, oil, but every other activity expanded. What does that tell us? It told us that the economy expanded basically from the angle of the non-oil sector. Non-oil sector expanded by close to approximately 96%, while the oil sector expanded by just 4%. And dissecting this data, we saw that the industry was the major driver of the Q2 GDP results, and it grew by 7.45% compared to 3% the previous corresponding quarter. And this is basically from, you look at the oil and refinery, increased by more than 15%. We look at energy and gas supply also increased. That's why we talk about renewable energy coming into play when it comes to the GDP numbers. That one, it grew by 11.47%, and we have construction also grew by 5%. So when it comes to service is another sector that drove growth. Services grew by 3.94%. And when you talk about services, you have the likes of telecoms, arts and entertainment, financial institutions, insurance, all of these activities grew compared to the corresponding or even the previous quarter. Agriculture is another sector that also grew and contributed to GDP massively. It grew by 2.82%. And that growth was basically from fishing and the crop farming. I think these are the two aspects of agricultural sector that really boosted GDP growth. And that simply implies that economic activity actually increased in the GDP. Look at the PMI, average PMI for Q2 also increased to 52.3%. Yes, this is 52.3 compared to the threshold of 50. So it's a plus. So that simply means that private investments grew in Q2, meaning that investors' confidence was high, because for economic activity to expand, it simply means that investors' confidence grew in that quarter. And what drove that confidence was basically the exchange rate that had been stable for quite some time. So people could at least plan for their investment. You are not just at the edge. You don't know whether the interest rate is going to drift from what it is, but it has remained stable for quite some time. And also the inflation has continued to decelerate for 5 consecutive months. I think these are the reasons why we are seeing this expansion, and we are seeing FPI inflow as well. So all of these factors are the major reasons why we saw this expansion in the GDP.
Dr. Mukul, I really appreciate the fact that, when you mention a sector, you connect it to a driver. And I really appreciate that, because I don't know if you've heard, but there are some dissenting voices following the recent numbers, the GDP numbers, especially when you look at the jump from first quarter to second quarter. And people are asking questions. Does this really reflect the true status of the economy at this time, this impressive number that we have?
Yeah, I said that the major reason, don't forget, why we have this jump in the GDP, let's not compare Q1 and Q2. In Q1, we usually see a slow in the GDP because of the festive season, December. Q4 is usually festive season, where you have spent all your money, dirty December and all the rest. Then in Q1, there is a slowdown in economic activity because people don't spend as much. This is when you pay your school fees and all the rest. But in Q2, economic activity set in properly in Q2. And don't forget that even in Q2, we saw that exchange rate was stable. This could be the reasons why we are seeing this spike. Exchange rate was stable, and inflation has decelerated for 5 consecutive months. That is a plus too. So, coupled with the inclusion of fast-growing sectors, and I mentioned these fast-growing sectors earlier. I mentioned the creative industry. I mentioned logistics. Then we have and others. So all these fast-growing sectors are the reason why we saw this push. These sectors were underestimated before now. They were not included in the Q1 results. That was why we saw that Q1. If we had our rebasing in Q1, I'm sure the numbers will be high too. But looking at the reality we are seeing, we may not see it translate into we will not have immediate effects on the masses. We always have a lag when it comes to all of this. There's usually a lag. The time you see the data and what you see in reality, anecdotal data and the real data may not be reflecting same, simply because there's always a lag.
Okay, all right. I guess that is why we still have that question of, while we have impressive macroeconomic data, the micro is still not reflecting it. So I guess is that lag. But when you look at this, 5 consecutive drop in inflation, now we have GDP at over 4%. Are we ready for a rate cut? The decision for the MPC is today.
Yeah, we are expecting a rate cut. The market is also expecting a rate cut. The Bloomberg even projected there's going to be a 50 basis point cut. But we are opting for a 25 basis point cut because we've seen there are some parameters the MPC will consider today, later today, and their inflation, which has declined consecutively for 5 months. Another parameter is the exchange rate, which has been quite stable for some time. And another parameter is the money supply growth, which was over 60% in January and is at 15% as we speak. So all of these factors put together are what the MPC will be considering. And don't forget that their major concern is price stability. Looking at growth rate is, I would say, is a secondary parameter to them. And while we say they are cutting by 25 basis points, of course, we have a strong growth rate of 4%. So a significant cut in interest rates might overheat the economy. Yes, it might overheat the economy because already with the data we have from the MBS, 4.2%, it means that economic activity has actually expanded, increased. So a further cut, significant cuts, will further increase economic activity. And of course, you know what will happen. We go back to the beginning, inflationary pressure and the likes, we come back again. So I think 25 basis points is cool and is more or less neutral. Even if it cut by 25 basis points, is neutral than having a significant cut. And let's not forget the fear of once MPC cut rate, we are going to see FPI reversal. Well, when the cut is minimal, I don't think we are going to see any reversal because compared to other countries, we see that we talk about inflation interest rate differential. Nigeria is still at advantage. We will see FPI influx into Nigeria, even if we cut by 25 basis points.
Who the MPC will listen to more, whether it's Bloomberg or FDC, it's in a couple of hours. We'll certainly see what decision comes out of the MPC meeting. Thank you so much, Vice President, Economic Research of Financial Derivatives Company, Dr. Ifeoma Nwokolo.
Thank you for having me, Mimi.